Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's Video Insight. When we talk about dancing close to the door, the immediate inference is that we're on the blocks and ready to sell at a moment's notice and as soon as the band stops playing. Well, it's not quite right. We're not clever enough, and most people aren't, to time the market consistently and accurately. So a much easier approach is to sharpen your pencil and be ready to take an opportunity to add stocks at better prices to your portfolio, and those better prices might be just around the corner. Let's put a bit of paint on the canvas and think about the United States. Believe it or not, there are some interesting parallels between what's happening now and the Great Depression. Back then, debt limits were reached right at the bubble top, which caused the economy and the market to peak in 1929 and 2007. Subsequently, interest rates hit zero amid a depression. That was 1931 and 2008. Then money printing started, and Ray Dalio called it the beautiful deleveraging. That was 1933 and 2009. And then, of course, the risk-on stock market rally began, 1933 to 36, 2006 to 14. We're seeing now, with median US stock being at market valuations reflecting a post-war record. Then, of course, the economy improves and we have a cyclical recovery between 33 and 36, 2006 and 14. And then the central bank tightens and a self-reinforcing downturn occurs, and that was 1937. Could it happen in 2015? Well, the US dollar strength is also a good leading indicator for weakening S&P 500 company earnings per share, and the US dollar has certainly gathered a great head of steam. Meanwhile, in Australia, our own market is expensive. Here at Montgomery, our own indicators suggest it's slightly expensive, and that's why we're about 75% invested. Interest rates in Australia could fall, however, below 1% if economists and hedge fund managers who predict a hard landing are right. Don't forget, we're reliant on China, and that economy is slowing at a rapid rate of knots. Both business confidence and consumer confidence are at recent historical lows. Even without further weakness in China, Australia is experiencing a classic weakening in income followed by investment and then higher unemployment levels. Business and consumer surveys, as well as employment statistics, which by the way are higher than the GFC for employment, have all turned or trending down. So it's no surprise that the ASX 200 companies reported a net 26% decline in profits for the first half of the year. The confusing thing, of course, is that the stock market and property market are going up. Yes, they might be expensive, but they're going up. And if the US experiences anything to go by, the Australian stock market could go higher for some time, which is why we're substantially still invested. The high-quality businesses we already own will be worth more in future years, and despite all of the forecasts and their forecasters' comments, the long-term direction of share prices is determined by intrinsic value. We expect to take advantage of any continued strength in the market, which is why we're 75% invested, and our 25% cash means we're uniquely positioned to take advantage of any weakness in individual stocks or the stock market in general. So that's what we mean when we suggest investors dance close to the door. You can step back into the party quickly or step outside for a breath of fresh air, and either move isn't going to be too taxing. I'm sure you haven't thought about it that way before. That's all for this week. We look forward to talking to you again next week. Please follow us on Facebook and Twitter.